Hello and welcome to the Quarterly Context webinar for the fourth quarter of 2018 for clients of the advisory group and WealthStep. WealthStep is the online division of the advisory group that provides a simplified service for up-and-coming clients and 401k client participants. Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal wealth and institutional clients better achieve your goals. And we try to keep these webinars to about 20 minutes, and we'll circulate a video link afterwards should you like to view some portion of it again or to pass it on to someone who you think it might be helpful for. If you have any questions, please submit them to the question box, and we'll either address those as we go along or at the end of the presentation. As usual, we start with a reminder to focus on your goals and what matters most, which ultimately are the elements that you can control and the things that matter. That overlap of those two things are where you can make the biggest difference, whereas it's not uncommon for the human mind to sometimes focus and experience a certain amount of stress over things that you can't control. Hopefully this presentation and the content herein will help distinguish between those two things. One of the things that we can't control are investment markets, and after a number of years of strong returns with a few hiccups along the way, we've again hit another bump in the road in terms of negative returns, with the U.S. and international stock markets all dropping for the quarter and also for the year. Not unexpected if you've attended these quarterly context meetings. We've been talking about valuations and other factors that would suggest after such a long bull market run, at some point there should be some element of correction or pullback as part of the long road path for investors, and that's essentially what's happening now. We can see here in the lower right-hand corner that the yield curve remains relatively flat, but not yet inverted, although there are a couple of points along the curve that inverted a little bit. And the flattening curve implies a slowing economy, and if it were to invert, that's sometimes an indicator of a impending recession. However, that's an inverted curve is not always such an indicator of a recession. So for the quarter, a few highlights. The Fed raised rates a quarter point. That plus slowing growth, falling oil prices, tariffs, monetary policy that continued rates. In other words, the government shutdown and other factors, plus relative highs for tech and some other non-tech stocks seeming somewhat inflated, all contributed to the weakness in the stock market. The Treasury for the bond market, the 10-year Treasury fell 55 basis points from a multi-year high of 3.24, and mortgage rates went up, which put some pressure on the housing market, which tends to also create or dampen the wealth effect for the average investor, which also therefore affects their confidence level and sometimes their nervousness regarding stock prices and willingness or interest in investing for the future. One slightly unique note is that Amazon jumped past Apple in terms of being the largest company by market cap. So it's the first time Amazon has held that position. And overall, corporate earnings remain relatively strong, but there is some increase in economic concern, which is what's driving those negative market returns that we're seeing. As a point of perspective, if we look back over the last year, we can see there are a number of news elements that several of which we just mentioned that impact the pattern of returns over the course of the year. And if we put that year into perspective, over the last 10, 15 years, you can see that represents a relatively small portion of that time period, and helps make the pullback in stock prices look a little bit less severe. In terms of economics, a few highlights. The gross domestic product for the U.S. slowed to 3.4%, essentially driven by consumer and government spending. More recently, with the Fed shutdown, there may be a little bit less in terms of government spending. And the estimate of the GDP for next year, or this current year, 2019 rather, from the Fed is about 2.3%. So not in recession territory in terms of projections. China also slowed to their weakest growth rate since before the global financial crisis. And that's one of the reasons that the international and emerging markets cooled, because of the uncertainty about the magnitude of China's slowing growth rates. Already talked about rates a moment ago. Inflation remained relatively stable. But more recently, energy, including oil prices dropping considerably in the past number of months, will begin to potentially pull down some of those inflation numbers, which may further confuse the Fed's question about the economy and whether or not to raise rates. The projections are that the Fed is still expecting to raise a few more times in 2019, but the market in general is expecting zero rate rises in 2019. Unemployment remains at the lowest level since 1969, still about 3.7%, and that now makes 99 straight months of jobs added, which is the longest on record. Wage growth is up, not dramatically, but has been on a bit of an uptrend in the last few quarters, and is around the same level as the 10-year high. However, still remains below the 50-year average of 4%, and that relatively tepid wage growth is, for the most part, being offset by inflation still. Consumer confidence remains relatively high, but there are signs that confidence may be tapering off with some of the market nervousness and other factors. Housing remains somewhat solid with some softening, partly due to the mortgage rates mentioned a moment ago. Already discussed oil, barrel price now down to $45. Pretty amazing to think that just 10 years ago it was at $148 a barrel. So that was maybe an excessive high, but now we're down below the longer term adjusted average. And OPEC and Russia more recently agreed to cut output to help stabilize and push prices up. So we'll see how that impacts markets. The dollar was stronger than most other currencies for the quarter, which affected international returns in bonds and stocks for U.S. investors investing in dollars. And those are some of the highlights. To point out a few things, digging a little bit deeper and seeing some of the patterns over time, we can see that here how unemployment has been dropping, but now hovering at this around 3.7 level, and you can see where wage growth has been picking up a little bit. The labor force, some of the underlying drivers of those unemployment numbers, you can see how cyclical unemployment has tapered off, how aging has been the primary driver, but other, which is often primarily people choosing whether or not to participate in the labor force, that's also been a factor, since it only counts people who are actually seeking jobs. Inflation, as you can see here, remains relatively similar to recent periods. Consumer sentiment index is up, but maybe cooling off soon. Oil, as you can see here, took quite a steep drop recently, and corporate earnings remain relatively strong, but with some economic concerns that might cause those to cool a bit. You can see the result of the market cooling has led to a price earnings or valuation drop here. So we're now below the 20-year average or so. Similarly, across other markets, on this basis, looking back 25 years, stocks are looking relatively more attractive. That's oftentimes and generally a precursor to stronger returns. It's just not quite clear when the market will turn or find its solid bottom from which it will take a bounce back. The dollar pattern is shown here. A little bit of strength after a little bit of cooling after a period of several years of rise. And you can see the VIX or volatility measurement here is certainly picked up with the volatility of 2018. To take a peek at one of the factors that is and will affect the market is debt. And we can see here that, well, not in actual debt numbers, but as a ratio of disposable income, consumer debt has dropped, which is generally a good sign in terms of economic stability. However, the corporate debt numbers have gone up to new highs, and that creates some questions about imbalance in the economy and maybe some overextending by some corporations, especially given that some of that is going into buybacks and dividend payouts and other things that aren't necessarily fully reinvesting into operations and services. The federal debt is also, while not at a all-time high, at a modern times, last number of decades, a high with projected numbers going higher. That's partly a result of spending levels being relatively the same or increasing with tax cuts eliminating the revenue sources. Taking a look then again at markets in the long-term pattern, we can see the four bad bears and what the recovery has been like, and now in the next segment of that pattern, still generally ahead of the long-term average. If we were to draw a line of the expected returns would be somewhere here. So this is just really reverting to the mean, which is something we've been talking about for a while. So not necessarily too much reason for concern. It's a natural part of the market truing itself up over time at this stage. Taking another peek at that over the last 10 years, since the end of the global financial crisis market, or from the bottom of that market, many people forget that there have been now 6 declines that were greater than 10%. And in 2011, there was one that was almost the same drop as we're experiencing currently, almost 20%. So even in a period of rising returns, it's not uncommon to have some corrections, which are generally considered to be 10% drop or greater. We would think it's more likely that returns flatten out after some period of volatility with more tepid growth for a period of time, as opposed to such a strong rise as we've seen in the last 10 years. That's an unusual rise and not normal over the long run. For more perspective on volatility, it's important to remember that, again, that corrections are a normal thing. They're not easy, comfortable, or fun. However, some people view it as a little bit fun when rebalancing, because you're essentially buying cheaper securities, more shares for the same number of dollars. So in the long run, that type of rebalancing adds value for people who are adding, especially for those that are adding money to their portfolios in accumulation stage, but also still for those that are in spending stage and are able to rebalance and capture some of that opportunity. So to see a pattern here of the number of drops, the frequency of magnitude of drops, market coolings to the tune of about 5% or more happen about 3 times per year. 10% usually happens about once a year. 15% drops usually every 3.5 years, and a 20% drop or more usually every 6 years or so. And here are the number of days that it usually takes in that process of dropping. So each one takes a little bit longer here, and we'll see in a moment how recoveries, what those patterns are like. But just before we do that, we can see a different visual that we showed in the last quarterly context presentation. This is a very small, but just as a reminder, you can see the pattern that the rises are larger and longer than the drops. And so that's not always comfortable to experience the drop, but historically and systematically over time, there is more rise than there is cooling. Here we can see that markets do generally recover fairly quickly when there has been a drop of 15% or more. There's been an average return going back for the last 50 years or so, or actually going back more than 100 years, pardon me. The average return after a 15% or greater drop is a 55% increase. So that is a significant recovery. What we don't know yet is quite when the market will find its current bottom from which it might have such a recovery. And if we take these two lines or view these two dotted lines, just visually estimating here, you can see that the most common size of drop is when it's over 15% hovers around the 20% range, and that the most common sized recovery hovers around a 35% range, just to eliminate, if we were to eliminate some of the outliers. It's also interesting to note that despite there being 10% drops yearly on average, 31 of the last 41 years ended positive, even though they had negative corrections within those same years. So again, volatility is a normal part of long-term investing. Another element of patterns to discuss, and it's interesting to keep an eye on, are the value versus growth dynamics and the U.S. versus international return patterns. So here we can see a relative returns chart that shows that while growth has really over the last several years been especially strong, there are periods where value is stronger, and those patterns tend to trade places in unexpected ways and with unexpected timing. So some of that is happening a bit right now, with growth stocks taking more of the punishment with the market cooling than value. And the same is the case for international versus the U.S. In terms of overall patterns over time, with recent years for an even longer period, the U.S. being in favor. But patient investors tend to experience extended periods of international being in favor as well. So maintaining diversification pays off in the long run. For the asset class corner this quarter, thought we would just highlight, sometimes people are curious to see what the number of actual stocks is in the U.S. Overall publicly traded universe. And you can see here that it's hovered over time from 1979 from about 5,000 up into the 7,000 range. And interestingly, the number of stocks has shrunk in recent years considerably, not quite by half, but a considerable drop. But most of that change has come from the shrinking microcap universe. So it's not surprising that the smallest companies are the ones that start and fail the most. And by definition, those that are larger are those that have been more stable and have had more successful runs and business models over time. That microcap portion of the market, even though it's large in terms of quantity of stocks, is a very small portion of the overall market, where you can see the proportional market cap weighted visual here. Taking a look at quality for the quarter, for the first time in a while, quality outperformed, higher quality stocks outperformed lower quality stocks across the board for the quarter and for the year. Not surprising, given that that's common in more significant negative markets. And we can see that the highest quality stocks, A+, although A was towards the bottom, interestingly, but the highest quality stocks have outperformed a little bit more recently, but have been towards the bottom for a number of years, given a more speculative, low interest rate environment that favored riskier business models and companies with more debt and weaker balance sheets. So different part of the economic and market cycle, and again, portfolios benefit from a combination of both high and lower and medium quality across the portfolio. In terms of fund flows for the quarter and what this tells us about investor behavior, generally tells us what not to do. You can see that a bunch of investors threw money into cash and bonds, and in the short run that may feel comfortable, but as you know, in the long run, and as we'll see in a moment, reinforced by a different slide, in the long run that tends to damage results. And over the last several decades, the average investor getting in and out of asset classes, generally with poor timing, missing markets, buying high and selling low instead of the reverse. Not that we would encourage tactical investing, but following buying high and selling low tends to systematically damage portfolios. So talking more about that discipline question, when volatility picks up as it has, it tends to create stress. It tends to trigger the portion of the brainstem, the smaller part of the brain that the amygdala, and that controls the fight or flight reflex rather than the prefrontal cortex part of the brain that controls rational decision making. It tends to increase concern. That part of the brain is designed to save us when we are in physical danger, which the farther back in time we go was a more important part of survival. But that same part of the brain is also activated when investment markets get volatile, causing us to react to financial fear as if it were a physical fear, and that can be harmful. So what this chart shows, the blue line is the S&P 500 year return over time, so plotting the different one-year lookbacks over time. And then the solid bars shows the rolling 12-month inflow or outflow into mutual funds. And so you can see as the market was cooling here in the beginning of the global financial crisis, a lot of money flowed out. But then even when it rose, the outflows calmed down. But because this global financial crisis market was such a shock to so many people, being the second worst market drop in history, money actually, despite positive returns, even though some of them were lower positive returns, but still positive returns, despite these positive returns, there was still a wall of money coming out of funds until relatively recently, until really 2014. And that is right when there's been more of a systematic cooling of the market, followed then into negative returns for some period, then followed by outflows, followed by a rise, and one of the largest periods of inflows into the very top of the market, now followed by a difficult market. So again, an example of what not to do. Generally, it's a much more effective and success plan to develop a long-term plan based on your specific financial needs and spending needs in the future, and to develop a savings plan and spending plan around that with an asset allocation that would be adjusted over time according to those needs. And rather than responding, changing asset allocations with emotions as they occur in response to market volatility. So discipline really matters. And as a reminder, one element that can help is to maintain enough spending money on the side, not have that in the portfolio, so that that tends to help people for short-term money pay be more disciplined with their long-term money, knowing that their short-term money is available without fluctuations. In terms of the rules and regulations and reminders corner, not a whole lot in terms of rules and regs updates for fiduciaries or for personal wealth. The only really notable thing is that we're now in the first tax season under the new tax rule, so your accountants are probably having fun starting to sort through the complexities and uncertainties that continue in that community around the new law. In terms of WellStep, making progress there and working with the development team with a launch goal of sometime in the second quarter of 2019. We had great feedback from the beta testing in recent months. And we also sent out to fiduciary clients a volatility communication for plan participants. So if you did not receive that, please let us know. And if you did receive it and haven't yet sent it out to your plan participants, we would encourage you to do so because it will help them stay the course with covering topics in some ways, a summary of key elements we've talked about just now. The blog for WellStep is also, and for that matter, the advisory group also has other historical blog posts on volatility that can be helpful. A few other miscellaneous notes. After a couple decades of a growing number of mutual funds in the industry, the first time it's actually now shrunk, which in our view is good news because some of the more expensive funds are simply not cutting it, and it's becoming generally a more attractive universe for the average investor. So that's just a hair of progress there, but headed in the right direction for the general consumer. An interesting change in terms of the structure of one of the indexes, the S&P 500 revamped a communication services sector as of the end of September, and that sector now contains certain consumer discretionary and tech names such as Comcast, Netflix, Google, Facebook, and so forth, rather than some of those names being in tech or other sectors. So the way the overall index is essentially the same, but the way it's broken down into its subpieces is being redefined. Regarding bond indexes, the Citigroup indexes were acquired by FTSE, and so you'll see a new label if you are looking at any fixed income indices that we might use that were previously the Citi indexes. With that, we'd like to thank you for attending today. We value your thoughts and are always interested in knowing how we can better support you. Please feel free at any time to let us know how we can do that better. And if you have one thing that you think would make a big impact on your peace of mind and your process, we'd like to hear about it. And as always, our growth comes primarily from introductions and referrals from our current clients and friends of the advisory group to others that need the type of help that we provide you. So you are helping people by helping us get to know them and help others. So we thank you for that in advance.